Hello, everybody, and welcome to this webinar on accelerating growth, C&I project development in Asia. I'm Franny Flinterman, and I'm Solarplaza staff. I'm project manager working on the Future of Energy, an event we will host at the end of February in Amsterdam. And we are excited to start this webinar as part of the run-up to the event. For those of you who don't know Solarplaza yet, let me quickly introduce us to you. We are a global event organizer specialized in PV conferences. We are based in Rotterdam, the Netherlands, and we have hosted numerous events around the globe. We have a PV network or a network of 60,000 PV professionals all around the world who join us in those events. As said, this webinar is part of the run-up to our Future of Energy event. We will host this event on the 29th of February and 1st of March in Amsterdam, and we host it in cooperation with FMO. We expect to have around 500 attendees joining us there and over 75 expert speakers. So please check out the event website on solarplaza.com and make sure to not miss out on this great event. Before we get started, I have a couple of practical notes to share with you. Please feel free to ask any questions you have to our speakers. You can use the questions box for it, and our speakers will answer these questions after their presentations. You can also use the questions box for any technical issues you might encounter. Our staff is here to help you with that. And we will be recording this webinar. The recordings and the presentation slides will be shared with you in the coming few days. So our moderator of today is Robert Voskuilen. It's a pleasure to have him as the moderator. He's the head of the energy team for Eastern and Southern Africa at FMO. He's a seasoned transaction leader in project finance and corporate finance in private sector infrastructure and energy projects. And he has been with FMO since 2007 and worked on projects in Latin America, Asia, and Sub-Saharan Africa. So glad to have you here, Robert. Welcome. And now let's get started. Have a very good webinar. Floor is yours, Robert.
Thank you, Franny. And indeed, we are very much looking forward to the event next month in Amsterdam, the Future of Energy event. And also very excited about this run-up, the C&I webinar focusing on Asia. So I'm with FMO. FMO is the Dutch Development Bank. We are a public-private partnership. We are all about impact investing. We have a portfolio of roughly 13 billion euros spread over 85 countries and spread over the renewable energy sector and climate finance, sustainable agri-food and water, and financial institutions. The agenda for today. We have 3 presentations, and we will start with those. And thereafter, there is the possibility to ask questions to the presenters. We are very excited to have 3 very seasoned presenters, seasoned in the C&I space in Asia. So we have Manikkan Sangameswaran, the Executive Director of Radiance Renewables. We have Steve Rawles, the CEO of Green Roof Asia, and Sameer Tirkar, a Principal Investment Officer at responsAbility. So let me start introducing the speakers. So Steve Rawles. Steve oversees the day-to-day operations of Green Roof Asia. Green Roof Asia being a joint venture between Climate Fund Managers and Norfund. Steve drives company growth, developing strategic initiatives, and promotes a positive company culture. Green Roof Asia is operating in Indonesia and Vietnam. And prior to his work at Green Roof Asia, Steve was with BSIS, which is another well-known name in the C&I space in Asia. Then Sameer Tirkar. Sameer is a principal at responsAbility. He's a seasoned climate finance professional with over 16 years of experience investing across different sectors and different value chains in the renewable energy space, energy efficiency, energy access, and infrastructure and financial services. He currently works at responsAbility. He is focusing on Asia, and he's actually leading the Asian Climate Fund, which, by the way, is also well known to FMO. And he manages the complete life cycle of transactions from sourcing, structuring, due diligence, documentation, closing, and monitoring. We will start off the presentation round with Manikkan Sangameswaran. Manikkan is the Executive Director and CEO of Radiance Renewables. Manikkan has over 20 years of experience in infrastructure, executing large transactions. Prior to Radiance, he founded actually Origin Renewables, and Origin was acquired by Radiance in 2020 and is now one of the larger C&I renewable energy developers in Asia, focusing on India. Prior to Origin and Radiance, Manikkan was also in the financial services industry with ICI Venture Fund, with ABN AMRO, UBS Securities, and SPC Warburg. Now, over to you, Manikkan. Please start your presentation.
Thank you, Robert, for that kind introduction. Good afternoon, everyone. I'm not able to move the slides. Is it possible, Robert? I'm some difficulty here. Yeah, got it back. Okay. So what I'd like to share today is the approach that Radiance has taken and the market perspective for the C&I market in India. The agenda largely what we are trying to cover is a sector overview, the C&I market, the way it's segmented on a sectoral basis, what has been the Radiance story so far, and what are the different kinds of renewable energy procurement models that exist in the Indian market, and how it is helping customers save money, and how it is creating a sustainability impact for our customers. And the last part is how do we accelerate our growth by differentiating our solution and offering much better and sharper solutions to the market. So these are broadly the topics I thought would be relevant for this audience today and focus on covering those agenda points. Moving to the next slide, just to give a bit of background, India is a very large and growing power market. It's a very booming market. We are having a GDP growth of around 7.2%, and it is the third largest electricity market in the world, but it's still the most underpenetrated market. As you can see on the left top chart, that the penetration of, in terms of demand, it's only 1,255 units per capita, which is one of the lowest in the world. Having said that, we are growing very fast, and we're one of the fastest growing market in the world in electricity demand terms at 5%. And the interesting thing is we are also the market where the LCOE, or the levelized cost of energy, over the long period is lowest in India. As you can see on the chart on the right hand side, we are operating at close to $25 per megawatt hour, which is very, very low, among the lowest in the world. This is what makes India one of the fastest growing and the most attractive market, not only for investments, but in terms of ability to build the business faster. And within that space of the largest growing market in terms of energy demand and power demand, we believe that the C&I market, which constitutes around 50% of the consumption today, agriculture constitutes around 18%, and the domestic consumers, residential and other market, they are consuming around 24%, and the remaining is split across other commercial other establishments. Out of this total C&I market of 50% that we are talking about, that translates into almost 844 billion units of power requirement per annum. And what is being met today is only 5% of this requirement is being met through the renewable energy sources. And within that, we have tried to split on the bottom chart. On the right hand side, you would see that only 44 billion units out of the 844 billion units are provided through the RE sourcing. And within that, largely so far, because the Indian market started off largely with the open access wind market, and now the open access solar market is gaining significant speed. So it has now occupied almost 18% of the market share within that 5% of renewable energy consumption. And the rooftop market is also growing, although a little slowly. But again, that is constituting around 20% of the overall mix of the renewable energy that is being consumed. So that just gives you a little bit of background and the lay of the land in terms of where the market is and where the opportunities are. So we try to analyze what is the open access market in India, what is the historical perspective, how is it moved. So you would find that until 2018, the market was still relatively small, less than 1 gigawatt a year. In 2018, there were tremendous incentives that came in terms of wheeling and banking arrangements and charges, exemptions of using the grid that gave a big boost to the setting up of open access market in India. Of course, those incentives have been phased out because they were available as a policy initiative for accelerating growth. And certain states had those initiatives. So we saw Karnataka as one of the southern states in India had that incentive. If projects were completed by 2018, then those incentives are available for 10 years of the project. So those projects, suddenly you saw around 2 gigawatt of market coming up in just in that year in 2018. And subsequently, there was a slowdown. There was an impact during COVID. 2021 was a bit of a slow period, and now the market's bounced back post-COVID. We are now seeing this market growing at around 3.5 to 4 gig per year at the moment. So this is just the C&I open access market I'm talking about. Of course, the larger solar market is much bigger, and we are just restricting this discussion on the C&I market at this moment. So definitely the open access market is growing very fast. It's very attractive, and it is also attracting a lot of investment. And the market so far in the C&I space and open access has been largely driven at the state levels, and therefore is also limited by the regulatory challenges in certain states and the policy uncertainty that exists in certain states. Now, these have all undergone a lot of changes since the time we started building this business in 2020. So in the last 3.5, 4 years, we have seen a more and more positive environment that is coming up in almost all the states in India. So that gives you a bit of a historical perspective. We believe that the outlook for corporate RE power is very sunny, and that is because the corporate market today is having substantial savings while also achieving their sustainability goals. So we see that this corporate renewable capacity addition is growing at a CAGR of around 23%. And out of that, the mix between the open access wind and the open access solar and the rooftop, this mix is undergoing a dramatic change, with the open access solar gaining a lot more sort of traction because of the benefit of very low cost and affordable power to the corporate and industry. So this is driven by both economic considerations and also the environmental benefits available to corporates. What we see recently is that a number of corporates who are in the business of exporting products and services internationally want to green their sort of production of products and services, because they're also serving the export markets, and the export customers are actually demanding sort of a greening of the supply chain. So that's also driving further demand, apart from the fact that the Indian manufacturers and service providers find a huge value proposition in shifting to renewable energy. So what we see is that in the next few years of 35 gigawatt of annual addition, almost 10 gigawatt of additions would likely come in from the C&I market. So this market, which used to be a 1 gigawatt market, is suddenly grown to now 4 gigawatt, and we see that in the next 5 to 7 years, it will grow to around 10 gigawatt per year. So it's a pretty large market that nobody would like to ignore. The next slide, this slide, we are trying to show which are the attractive sort of states where C&I market presence is currently there. And this is an in-house assessment that we do at Radiance in terms of 4 parameters that we look at: the policy environment, the attractiveness of that particular state from a financial perspective, in terms of the renewable penetration already available in that state, and the availability of land and resources in that particular state. So we have ranked these particular states in India, and we give the top states a ranking of 1, and the other states they sort of sliver. So from our perspective right now, there are like 6 states which are the top 1 and 2, where there is a lot of interest that we are having, and we are building a lot of capacity and business in these top 6-7 states that we highlighted in this chart. Um, and I think the industrial sector today in India is still largely dependent on the grid and brown power, and therefore there is a strong case of for renewable energy for green badging for exports, which I talked about earlier. In terms of the market segmentation, where is the demand really coming from? Where in terms of the C&I market customers? So if you look at this pie chart on the left hand top side, you will see that a large amount of manufacturing in textiles, engineering, chemicals, automotive, aluminium, refineries. These are all customers, and now the more newer sectors like data center are consuming significant amount of power. In one study that we have recently come across, data center is expected to data center itself is expected to have at least 5 gigawatt of demand on a per annum basis. So if you start looking at catering to these sectors, then the overall demand is growing very significantly. And what we also tried to do was to look at customers who are having more than 1 megawatt load of demand, because these were the people who were eligible for open access. And we did analysis. So the top right chart shows you which are the sectors which are actually the heavy guzzlers of power. And when we look at that, we say that today a number of these customers are actually meeting their demand through captive thermal power, which they want to replace with renewable energy. And that's where I think the demand is going to be significant. And as I said earlier, the current penetration of renewable energy within the demand is only 5%. So there's a long way to grow in terms of the market requirements. And our sort of focus on dealing with customers within this segment is pretty much reflective of the demand profile that we see across segments. So we are focusing a lot on manufacturing companies like the steel, the aluminum industry, the cement companies. We're looking at data centers and sort of chemicals and automotive companies. So these are exactly the same sectors that we see a lot of demand coming for our sort of service of renewable energy as a service. What has been the Radiance story so far? So, we call ourselves as a COVID baby startup. We started around 2019 towards the end, and we were hit by COVID pretty much as we started the business. We started with a team of 5 people, and today we have grown to around 100 people team. At that time, we had a small capacity of half a megawatt that came in along with the acquisition that was done of my business. And from there, we have grown this business from half a megawatt to now around 500 megawatts in a short span of 3.5 years. So we have had the platform has grown at almost 10x over the last 2 years, despite the economic slowdown and despite COVID. And this was a very interesting phase of growth because the most of the PPAs in India that you sign are anywhere between 15 to 25 years, and usually corporates do not like to sign virtually in terms of getting on a call and agreeing to terms and conditions for a PPA. But COVID taught us that we could change the model, we could adapt, and I think the Indian industry also responded pretty quickly, and we got the benefit of building this business in a very fast way during a time when COVID was in place. But that also meant that we had challenges on the ground in terms of executing those projects. And I think despite all of that, we have built a reasonably good business. We did a few acquisitions in the initial evolution of our organization. As you see, we had acquired around close to 33 megawatts in between the 2021 period. And then most of the build out that happened was all based on greenfield. We built a lot of expertise in terms of engineering, design, asset management, and all the other functions that go in terms of running and operating this business. And now from here on, we are looking to end this year with more than 600 megawatts, and then go on further to build up to 2 gigawatts in the next 30 months time. That's the target we're taking for ourselves. And then beyond that, we'll be building another 400 to 700 megawatt every year. That's the current plan that we have. If you look at the functions, we have sort of built the teams across business development, which is part of the value chain, project development, project management, execution, asset management. We have a very strong finance team and a very, very strong and committed ESG and EHS team, which is an absolute must for us, the way we are building this business. So this gives you a little bit of a background on Radiance. And in terms of the procurement model, what does the market ask for, and what are we sort of giving in the market? So basically, there are like 3 or 4 models. One is behind the meter, where you're putting the project at the customer's premise, where either on the roof or on the ground. Third party model is where you are putting up the project outside and using the grid to wheel the power to the customer. And in the third, group captive is nothing, is not very different from third party, except that the customer also has an equity stake, which allows him to get a certain exemption in terms of charges, open access charges, which gives him a tremendous saving to the customer. And the last one is group captive intrastate. So the difference between the third and the fourth column is that the third one is intrastate, so it is within the state. We're producing the power within the state and supplying to the customers within the state. In the fourth model, it is basically we are generating power in a different state, and the consumer is located in a different state. So we are basically using the central grid and the transmission grid to sort of distribute power from a generated source to the customer point. And in terms of the contractual terms, pretty much the models are either BOOT or a BOO model. If it's at the customer location, we prefer a BOOT model because we can't, it's very specific to the customer. When you look at the benefits, all of these, I mean, if you look at, except for the captive model, where the customer actually invests 26% equity into the project, in the other first two models, there is no equity investment for the customer. We are responsible for building, managing, owning, financing, and running the plants, and that continues to remain. But in terms of savings, the customer has more savings in the group captive model, and also there are some benefits that are available to the customer in terms of the monthly banking, which is available of excess energy, and these are all the, but that's available in the intrastate model, not available in the interstate model. In the interstate model, you got to settle within the 15-minute slot that you have. So there are positives and negatives of each model. It's purely a function of what is the requirement of the customer, what voltages they are connected, what is the landed tariff coming to, and how they can save money in terms of the overall cost of supply to the customer. So each of these have different shortcomings, as I said earlier. Behind the meter has limitation because the roof area or the ground area available on premise is limited. In terms of the third party model, the savings are lower. It's around just about 5%. In the group captive model, obviously there is regulatory uncertainty sometimes that comes in. And in the group captive interstate, there is no banking facility available. So right now, the most prevalent model that we have been doing a lot of business is in the third column, which is the group captive intrastate. We are also now pivoting to the fourth model, which is a group captive interstate model. So that just gives you a sort of a overview of the different procurement models that are available in the market. In almost all cases, what we find is in a typical group captive model, customers are able to save at least 30% of their monthly electricity bills, which flows directly into the bottom line of the customers, because this is a straight flow into the EBITDA for the customer, and that's a straight savings without significant investment. Even the 26% equity that they are investing, there is a payback of less than a year, so most corporates don't have an issue with that, and they have secured renewable energy for a very long period of between 15, 20, 25 years, depending on the tenure of the PPA. So this is, and they are also able to meet with the sustainability scorecard in terms of the impact that is being created. As you can see, 1 MVA of 1 megawatt AC project would deliver 1.5 megawatt of DC and would end up with 228 tons of coal consumption reduction that we would see. And obviously, these are statistics that we are all used to seeing. In terms of the differentiation, how are we differentiating our sort of business with the others? We believe that this business is a completely solution-oriented business. It requires a lot of customer engagement. A lot of time has to be spent on quality of discussion, understanding the consumer's demand, voltage level, the bills, category, etc., and whether we are able to deliver to the customer within the timelines that is being talked about. So that's the first part of the engagement that we do with the customer. And the second part is the solution building, where idea is to deliver at least cost to the customer, look at the highest displacement by using technology like trackers, and also in terms of whether we can look at dollar indexation on the PPA or virtual PPA. And all of this requires a lot of understanding of the policy and regulations. So this is is what differentiates our solution. A couple of last slides I want to just cover. One is that how does a customer move towards, how do we sort of, what is the difference between ISTS and INSTS? INSTS is largely intrastate model, and the ISTS is largely interstate model. This is only possible if you are connected at high voltages. If you are less than at 66 kilowatt, you would not be able to deliver it on interstate because the economics won't add up. So we find that this model that is working out, the data centers while they have high voltage connection, they still don't want to do interstate because they are worried about the local state center dynamics. And commercial parks, distribution licensees, these are all people who continue to operate on intrastate model and not on the interstate model, despite being connected at high voltages. So this is broadly what we are looking from a solutioning perspective. Just a quick slide on how Radiance's business has created an impact. As you can see, we adopted to three sort of SDG goals, goal number 6, 7, and 13. And each of these, we measure our performance in terms of how much water we have saved for the planet and how much renewable energy we have generated from our plants and what is the impact on the carbon reduction that we have done. So these are numbers. They're available for you to have a look at. Um,
Thanks a lot,
and
Manikkan.
last but not the least, just a couple of slides here, just showing what kind of projects we have. One plant is the Maharashtra plant, which you have on the left-hand side, and the Karnataka plant is on the right-hand side. These are two relatively smaller projects. We are building a much bigger project of 200 megawatt plus at the moment. So I think I would
Manikkan.
sort of I would close that, Robert. So I can hand over
Yes.
the controls to you.
Thank you very much for the elaborate presentation, Manikkan. Very informative and very impressive. Also, the growth up to the 600 megawatts in what is it, 4 or 5 years. One question, and I really ask you for a very short answer. With the let's say the third party and the open access model, which is growing in your portfolio, are you then also not onboarding more merchant risk in the end, or exposure to changes in open access charges?
Yeah, so we would like to do merchant projects, but unfortunately, the financing is not available for merchant projects. So what we do is that we do a small portion of the capacity within the overall park, which with larger capacity being the group captive, and maybe 5 to 10% of merchant capacity that we can look on a third-party open access basis.
Super. We can park the answer and the question for Sameer later on when we talk about financing. Now we are going over to Steve Rawles. Steve, welcome again. Green Roof Asia. The floor is yours.
Thank you very much, Robert, and a warm welcome to our guests that are here today for this webinar. I'm just going to give a very high overview on 3 main sections here today. So firstly, I'll give some background as to Green Roof as a developer and what we're doing in Southeast Asia. I'll also give an insight to the markets that we're currently working in. And finally, just a few case studies of projects that we have either in operation or under construction currently. Okay, so for this first section, it will be for Green Roof Asia and just a little bit about us. So Green Roof Asia, as a whole, we are a developer of renewable energy projects in Southeast Asia. We're focusing mainly on the C&I sector, primarily in the rooftop market. Business model is to finance, construct, operate, and own projects across Vietnam, Indonesia currently, with the vision to move into Philippines later this year. These will continue to be the stronghold markets for Green Roof. In terms of Green Roof structure, we are backed by climate fund managers, namely Climate Investor One and Norfund. CFM are currently operating in more than 18 countries, and Norfund, whose large portfolio, already 50% of those are focused in clean energy investments. So back to how Green Roof help its clients and really the Green Roof mission. We're really looking to be a long-term partner to reach sustainability goals and enforce that transition and to essentially reduce the carbon footprint of our clients. And we're really looking to provide green energy solutions to reduce energy costs in general for our clients. Now, this obviously doesn't come without its challenges. What we normally find is with a rooftop application, it is normally the quickest and fastest for our clients, but generally we can only reach up to around about a 20% reduction in the carbon footprint. So I would say the main challenge that we see in Southeast Asia is how we speed up the progress of other solutions going beyond rooftop solar. Another challenge that we are facing is generally in Southeast Asia, you will find that the electricity price from the grid is remarkably low. So Vietnam, for example, you're looking at around 8 cents a kilowatt. So of course, in terms of investment and making commercial decisions for our clients, it can be quite challenging because of course we want to help the transition, but not at the expense of further operational costs for our clients. So a little bit on how we're doing this and how we face this for our clients. We predominantly work in a PPA model. As I said, we work over a 15, 20 and 25 year option for our clients. Now, what we see from that is, as I said, the commercial aspects obviously get a lot easier for these longer term PPAs. But of course, it can be quite difficult for our clients to make these sort of decisions for such long term commitments. So these are probably the main bottlenecks that we find in Southeast Asia as we try and enforce that transition at the moment. So moving on to just as I say, a high-level overview for the 3 countries that we currently operate in. And I'll be looking at 3 main sections. One will be the renewable energy policy of each country, the growth in terms of each country, in terms of its investment, and the regulations that are currently in place. And I will be focusing mainly on the rooftop solar market as our core business. So for Vietnam, although it's been slow over the last couple of years, we've really seen great commitment from the government. Certainly last year, June 2023, where Power Development Plan 8 was approved, and this really shows the commitment from the government to really try and hit that net zero target of 2050. We also have the well-known growth of Vietnam. It's been a very stable market and it has always attracted a lot of investment, and that continues to show promise. In terms of regulation, as I say, it has been slow for Vietnam. The last incentivized program was the Fit 2 policy, which ended in 2020, and since then there's been no clear guideline. Now, what makes quite a challenge is we still see a huge demand from various clients in various sectors to really push for a carbon reduction. However, without the clear policy, the timeline for implementing these projects is much slower, and permitting and licensing has become a real hurdle for Vietnam. Looking at Indonesia, in terms of its renewable energy policy, it is falling short. It's only been in the last month or two that officials have come out and admitted that they are off track for the 2025 goal. So they are looking for new ways, some new innovation in how to catch up these goals, to really see out the policies that they had put in place. In terms of growth and investment opportunity for Indonesia, it is very similar to Vietnam, a continual growth that we're seeing there, and a solid investment, and hence that we've established ourselves out in Indonesia as well as Vietnam. When we look at regulation, different to Vietnam, we're very happy to see that we do have an actual regulation and guideline to follow there. So it does make the implementation of projects a bit easier. In terms of its licensing, it is much more straightforward. However, we do see a 15% capacity cap. So the local grid are limiting the renewable targets and what they can achieve for each project that we're implementing. So there is some optimism. We're hoping that this will change. We're hoping that this 15% cap will be lifted. There is a new election, a government election that will be happening in February this year, and we hope to see that there will be a change on that and a real shift towards reaching the goals that were set out in the original policy. Okay, and I just want to do a quick snapshot on the Philippines. This is a new market for us that we will be moving into, and I think it's a really strong market. It's boasting Southeast Asia's largest 2050 commitment, even superseding Vietnam, which has very aggressive targets. In terms of its growth, again, very solid. It's similar to Vietnam and Indonesia, and hence was an easy decision for us to make this an extension to our investment mandate. In terms of its regulation, there's been some bold moves from Philippines government. 100% foreign ownership now being approved for renewable projects. And we've also seen a real great commitment from Philippines, emphasizing their transition away from coal, which was implemented in 2020. So I'd like to give you just a snapshot of some of the projects that we have constructed or that we're in construction, just to give the guests a bit of an understanding of the range and the different sectors that we find. And there are a lot of industries that are looking for renewable services, not just for the C&I rooftop space, but really looking to excel themselves to a net zero point of view. And I think it's well known that the textile industry has always been pushing for renewable targets, but we also see quite a few other markets and industries that are now pushing this same narrative. So we have a couple of projects here from Indonesia. We have TSH, which is a 1 megawatt project. This is for Adidas. This had quite a few challenges. They had quite a push from Adidas to be able to get this project implemented within 3 months. So we have one industry where is really quite aggressive, but then we're still looking at some other sectors where we have the central market, which is a very popular retail across Indonesia, and we're still seeing this being pushed in this sector as well. So it's quite interesting the varying industries that we see that we try and provide support for. Looking at some of our projects in Vietnam, we have a range of clients here. It can change from manufacturing to plastics. We've also got further down, we've got some car manufacturing, working with companies like Toyota. And we're seeing a real tech industry push in Vietnam. There's a lot of companies moving from China and are picking up a lot of the industry that is moving from there. And Vietnam has been selected as that place for factories to be set up. So the projects that I show here, as I say, either under construction, you can see the range of system sizes. They're essentially rooftop farms. We have a project here that you can see that is reaching nearly 8 megawatt. So these are really some quite large scale projects and a real push from the clients to try and hit these renewable targets. And so that is just a wrap up from me. Obviously, I look forward to your questions in the Q&A towards the end of this session.
Thanks a lot, Steve. Very nice presentation. Thank you, and also an amazing growth that Green Roof has experienced. Maybe one quick question before we turn to Sameer, and I can't help having the sort of banker's lens on. But with most of the projects being somewhat smaller than what Manikkan was displaying with Radiance, and most of them sort of behind the meter. I guess that your financing, so leveraging the projects, is done on a portfolio basis.
Yes, absolutely. So we're looking at it from a portfolio level. Of course, we are looking at behind the meter projects, but I think our core business is to try and make a renewable change on site for our clients. And then we're looking to obviously infiltrate with rooftop solar, and then we will be looking at some other renewable solutions to really drive that change.
Thanks a lot, Steve. So over to the Sameer, to the financing perspective in this panel. Sameer, the floor is yours.
Thank you, Robert, and hello, welcome everyone. Sure. So I'll be talking more about from a financial perspective, right, in terms of what challenges we have faced in the sector. It's a space that we have been pretty active in. As a quick background, let me talk about responsibility. We are a Swiss-based impact-focused asset manager. We have been around for more than 2 decades now. I manage close to $5 billion, and I have invested significant capital in the impact space since our inception. Climate finance, I think that's one of the key focus areas for us. Like I said, for climate finance, we have been there doing it for a decade now. We have 3 funds right now in the climate finance space, managing more than $1 billion. And this is all across the globe. We have invested in LATAM, Africa, Asia, Eastern Europe. So we have been active in all these markets. We have invested around $1.4 billion in the space, which is across both finance institutions as well as direct investments in climate finance companies, out of which around $225 million has been in the C&I solar. We have been doing C&I solar for more than 7 years now, and excuse me. I believe we were one of the earliest investors in the C&I space. It's a space we are still quite bullish on, and we see a lot of developments happening in this. So that's something we would continue to do. But as a team, today we look at much more beyond C&I solar, right? We are looking at the entire value chain on renewable energy, including storage. We are looking at energy efficiency and carbon mitigation projects. We are looking at energy access. We are looking at electric mobility and its value chain. So the idea as an investor is also to start looking beyond C&I solar, where we see a lot of traction. We have a very dedicated team of investment professionals. At the same time, we have an in-house team of technical experts who work with us on every transaction that we do, on technical diligence, on E&S diligence. So that's a core part of our investment thesis. In fact, even monitoring all our investments post disbursement is something we actively look at, so that there are, in case of any issues, we can look at any early warning signals. From a track record perspective, right, we have expertise across Asia, and we have teams on the ground. We have invested in India, Thailand, Vietnam, Singapore, more for a regional play, Indonesia, and other countries in the region. So our C&I expertise spans across multiple countries, I think, and that is something that has added a lot of value to a lot of investee companies that we have been working with. From a pure product perspective, right, we come from a more credit-focused background. But in the credit space, we have been fairly flexible. We have looked at everything from construction finance, portfolio finance, project finance, corporate loans, to even long-term working capital. And it could be simple, it could be structured. We look at the teams that we are working in and kind of really develop a solution for the C&I developer we are working with, rather than having a one-size-fit-all kind of an approach. I think that's been very well received by the market, and that is something we continue to do. I think, from an investment strategy perspective, like I was saying, historically we have been very strong on the C&I renewable energy space. We would continue to focus on that. We would continue to focus on, and we see a lot of innovation happening on the C&I space as well. We are looking at more hybrid solutions. We are looking at storage becoming more relevant. So I think that is something we would continue to do. At the same time, as I mentioned, we are looking at more energy efficiency or carbon mitigation projects. This could be anything from circular economy projects. We are looking at industrial wastewater treatment. We are looking at recycling. We are looking at and heating as a service, cooling as a service, IoT-based energy systems. So the scope in energy efficiency is quite vast, but the underlying principle is CO2 mitigation. The third aspect we are going to focus on is electric mobility and its value chain. We believe it's an important component of climate finance, and we are building up our capabilities in the space. Utility and energy access, I think we've been more active in Africa for these sectors, but in Asia, I think the first three are more relevant for us today. We have heard from Steve and Manikkan now in terms of how the sector is really growing, and we retain that bullish view. But at the same time, I thought, let me highlight certain challenges we as investors face while looking to finance projects in the space. I'll quickly run through that so that people have time to ask questions and people can answer. So as an investor, what are the key risks that we see, right, when you look at a C&I business? One is obviously the macro risk in terms of what are the countries you are operating in. These are generally emerging markets. We have to really understand the country risk of where you are operating. We are looking at macroeconomics. We are looking at credit ratings, the availability of currency. Can we repatriate currency? In terms of so these are the kind of risks we look at. Then we look at, we are not a local lender in any of these countries, right? So we have to look at how a foreign investment is treated in these countries. We are looking at things like tax. We are looking at withholding taxes. We are looking at laws for flow of capital, how easy it is to get money in and out from a country. We are looking at if there are restrictions on ownership, in case we have to enforce security and take ownership of certain assets, is it easy for us? How is the regulatory environment? So I think these are the kind of things that we are looking at. And finally, we also look at the local banking infrastructure, right? In the end, there is, in a lot of cases, there is some kind of takeout envisioned at the end of 3, 4, 5 years, even if sometimes we can do full project finance. But I think that's where we are coming from. The regulatory and legal environment equally critical. This is more sector focused, right? We are talking about what is the policy for for C&I solar. It needs to be favorable, or even if it's not favorable, at least it needs to be stable in the long term. If there is a lot of policy uncertainty, it becomes that much more difficult for an investor to really analyze how their investment thesis. At the same time, judicial systems, in terms of enforcement of security, how reliable it is. If we have arbitration in Singapore or London, can we really actually enforce arbitration awards in the local country? Ease of doing business. This is more at a developer level, but as an investor, we also need to develop a sound understanding. How easy is it to get permits? If there is land acquisition involved, can we actually get land? The approvals, do we get it before or after? If there are certain approvals that come in after commissioning, can it come on time? As a lender, you want the project to be up and running and in a timely manner. So I think this is also a very critical part. And finally, the ESG compliance that has maintained a standard in the country, right? Because that's a very good starting point, and then we can build on that. So I think that's also a critical element. The next slide. Yeah, sorry, the previous slide. Yeah, so the business and technology risk. This is now, coming down to the developer itself, right? What we are looking at is how have you really structured the business? What are the kind of off-takers you are dealing with? Uh, how are you, what is the scale of the projects? How are you commissioning? Who are your EPC contractors? And these are the kind of risks that come in with business and technology. If you're building in storage, what kind of batteries are you using? What experience you have? How's your supply chain? Where are you sourcing your panels from? So these are the aspects that we again want to focus, or we focus on. And one critical element is obviously the scalability of business models. A lot of businesses that we have interacted with make a lot of sense at a very granular level, but have a lot of difficulty in really scaling it up. For a lot of the international lenders, I think scalability is a very critical part of it, because we would want to deploy more capital, want to support companies that can grow, and it becomes very difficult for us to really look at very interesting but small projects. So we really see the commercial scale or the commerciality of any of these business models very critical for investors such as us. Uh, the last aspect that I would cover is more the challenges that as an investor we have internally, right? Emerging markets, all said and done, we are not experts in all the markets, right? So we have to develop our understanding on understanding these markets. Sometimes the investors in our funds are reluctant to go into each and every market, right? They want to limit the exposure to certain markets which are more developed or where we have a better understanding. So that is a challenge that we face as investors to trying to expand our scope of operations. Smaller deal sizes, again, like I mentioned, it is challenging because the amount of effort that really goes in to any transaction is, depending on the deal size, more or less the same. So, because we are looking to deploy capital, generally have smaller teams. We struggle to work on very small deal sizes. And it's like a chicken and egg. If you don't work with on the smaller size, how would they reach a stage where you could deploy significant capital? Thirdly is limited bandwidth. Like I mentioned, we most of the investors have small teams, right? We do not have very strong or large teams in each country. So we have to be very selective in terms of what transactions we can onboard and really deliver on. That really results in us kind of cherry picking a few transactions, unfortunately, but that is the reality of the business today. And finally, what I would also highlight is the limited knowledge we have on the off-takers right now. If you're a company working in a particular country, the ability to understand off-taker profile is very critical for any investor. If it's a large company, it's much more easier for us. If you're working as a multinational, as an off-taker, it's something we can take a call on, even large local corporates. But as you go down the credit curve, it becomes more and more difficult for investors like us who are not from the local market to really analyze the risk that we are entailing or taking when we do an investment. So it makes it that much more challenging, and sometimes we are not able to cross that bridge. So I think that is also something I need to highlight. Sometimes these might be good companies, but as an investor, we have no capability to understand that because we are not from that market. I think that's something that we have to keep in mind when you work with lenders like ourselves who come from a more global background. I think these are the overall points I wanted to cover. Like I said, there are challenges in the space, but the next slide actually talks about what really we want to do. But we still remain very bullish. I don't want to kind of say raise a red flag, but I just wanted that people should be aware of what are the challenges that we face as an investor when we look at these sectors. We have been very bullish on the space, and we continue to do that. But sometimes it's good for the developers to be mindful of what challenges they may face when they try to fundraise. I think that's about it, Robert. I think it's a short and sweet summary
Thank
from what
you,
I wanted to say.
Sameer. Thank you, Sameer. Very informative, and it shows also that you're very active in the market. That's great to see. We received some questions from the audience. There's one actually for you, Sameer, and you touched upon it a little bit, but basically the question is, it would be helpful for the audience to understand, let's say across the segment, solar, wind, manufacturing, EV, etc., what the size of the investments is for you, and whether there's any limitation per industry or subsector or per geography.
Good. So, like I said, I think I'll take it step by step. I think there are multiple questions rolled into that one. From a geography perspective, we are largely focusing on South Asia and Southeast Asia. We have, I think India might have the highest allocation. At the same time, I believe we would invest equally in Southeast Asia. For deal sizes, we are looking at around $15 to $20 million today in the space. And again, from an allocation perspective, see, our investment thesis is solar is something where we see a lot of pipeline in the immediate future, and I believe that might be a focus area. But if you tell me to if I normalize my portfolio over the next 3 to 4 years, I believe we see equal opportunities in all three spaces. Mobility is something that is really scaling up very fast in India and certain markets of Southeast Asia as well. So today we are not really kind of saying that I will only focus on a certain subsector. We are open to all interesting opportunities across all the three segments we are focusing on. Just to highlight what we really like is more B2B businesses. We are working with new technologies or new business models, but we would look at some B2C, from if you look at EV fleet or EV manufacturing, there would be some B2C opportunities as well. But C&I and energy efficiency, we see a lot of B2B opportunities coming our way. So we would look at all these segments seriously. And over 3 to 4 years, I believe our portfolio would be equally distributed between the three segments.
Okay, thanks for that, Sameer. Another question for Manikkan, actually, and although it sounds a little bit contradictory with the C&I space that we are talking about, because it is about basically days of receivables outstanding when you receive funds from state electricity companies in Maharashtra, AP, Tamil Nadu, etc. Can you elaborate on that, Manikkan?
So yes, that is true. In certain states, there are delays in getting the payments done on time. This is for utility projects. Fortunately, we are not in that business because our counterparties are all highly rated corporates, and we never have an issue in terms of collection. There can be times when there can be differences in the kind of the bills or some sort of understanding of what the bill amounts were, but that is a normal part of business. With regard to the utility payments for the utility companies in certain states. There have been issues in the past, but now that has been resolved by the government diktat that they have to be making those payments because there are bank guarantees given up, and those can get encashed. So I think that's how the government has fixed that problem. So I don't think that is an issue right now in the sector. It's improved significantly for both utility and for the C&I. It was never an issue.
Thank you, Manikkan. Another question came in, maybe for Steve to answer, and that is whether there is a role for renewable energy certificates to play in bringing viability and bankability to C&I solar projects in Asian countries.
Yes, definitely. And it's a question that we get asked a lot more. The first regulated company in Vietnam for certificates actually opened last year, but it is a question that we get asked a lot more, and it's something that we actually factor in for our clients. For us, we will obviously generate them because essentially it is our asset. So with our investment, we are able to generate those green certificates, and then we essentially give them to the client, and they are able to use them to obviously continue to promote their renewable target.
Thanks, Steve. Maybe a question for all of you, and then very brief answers. Maybe to start with Manikkan, is to what extent are you able and willing and stretches your risk appetite to accept merchant risk or partial merchant risk? Can also be much shorter PPAs than the lifetime of the asset that you are investing in.
Yeah, so for us, we have done shorter PPAs of 5 years, but that's a small part of our overall portfolio. Going forward, we would love to do merchant, but I think the current financial market's not developed in terms of the banks willing to lend to projects which have a very short-term PPA, especially when we are financing the projects on a long-term basis. Whereas in other markets, we have seen that this has evolved because there is a pricing model that runs and is available to the market with the banks rely on, like in Australia and UK, that allows them to finance and bank those projects even though they may have shorter term PPAs. Once that sort of structure evolves in India, maybe the PPA tenures can be collapsed, but at this point in time, they are very small. It's not because of our ability to take risk. It is just the fact that since 70% of the project capital comes from the banks, they are not willing to take the risk at the moment.
Thanks, Manikkan. And I think it's very natural now to go over to Sameer. Sameer, can you maybe respond to that?
No, it's a good point. I was just thinking about what can we do for these kind of things. See, honestly, in the past we have done one project with merchant risk, but it was a short-term risk. They were the project we had funded with merchant risk. They were scouting for a long-term PPA, and in the interim, yes, we had funded pure merchant risk for a project. The idea that within 12 odd months they would then find a buyer for the project. So I think what Manikkan said makes a lot of sense. The lenders are kind of hesitant to take that risk. I think one solution could be to have slightly lower leverage on these kind of projects to begin with, at least start doing something in the space, and then create a track record for lenders, other traditional project finance lenders to actually come in and then say, okay, this works. This has been working for the past 2-3 years. Let me try and increase the leverage slowly. And we have seen this happening. And even if you go to a new market, that this is what happens, right? You don't start with 70% leverage on day one or 75. You go in with slightly lower leverages. Over time, as the segment or sector matures in a particular country, you then start increasing leverage to 70, 75. I believe a similar approach is required to make merchant projects a reality.
So Sameer, if I can just add to what you just said, I think the other idea that we are implementing is we are pooling cash flows across projects, wherein a small set of project can be the merchant project, maybe 5% of that portfolio, which banks would still be comfortable on a 70-30 basis because 70% of on a 95% of the cash flows are on a basis. So 70% debt and the debt servicing is available. So these are kind of models we're exploring in terms of co-obligor structures.
Yeah, and I guess it also depends on the portfolio, and then in particular the depth of the C&I offtake market, right? So if there's enough depth in a certain country, a certain market, then you probably can get comfortable in the renewable options or the renewing options for PPAs that elapse over time. So then it may be more acceptable. Steve, what is your view?
For us, in general, we look mainly at the 15, 20, 25 PPA. We have looked at some shorter term, looking at more 10 years. But generally for us, certainly for the Asian market, as I mentioned before, it is quite difficult commercially with just the general economics, the lower pricing here. So I think in general it's something that we look at, but we normally optimize that we go for a long-term strategy for the client, because we like to try and push on to the foresight of different renewable projects that they may look at. So we're really looking to be a long-term partner.
Thanks, Steve. And a question to the audience, please send in your questions if you have any. In the meantime, let me bring up one other topic, and that is basically the availability of local currency financing. And I guess Manikkan in India, it's all rupee based, and banks are fairly liquid. In other markets such as Vietnam, Philippines, that may be a different ball game. Both Sameer and Steve, to what extent is the financing that you require or that you offer, Sameer, in your case, local currency based in the C&I space?
Steve, you want to go? Oh, okay, I can take this first. See, like you said, in Asia, a lot of the PPAs are in local currencies, right? So it makes sense to actually offer local currency funding. And we do manage to do that through our fund, because our fund has tie-ups with banks where we are able to hedge and provide local currency loans to these projects. Sometimes it is efficient. It's more efficient if the borrower actually hedges and we give a dollar loan and they hedge themselves with the banks that they are working with. Markets like Vietnam, Thailand, Indonesia, I believe it makes sense to do local currency. Philippines is a market where we have not really done too much, so I will not kind of speak about it. But I understand it's a very well developed local market is there. But local currency loans makes a lot of sense because you do not want to increase the FX risk of a project. Tomorrow, if because of currency values or variations, there are breach in covenants or there is servicing defaults, it's not something you want to do. So it makes sense to kind of offer local currency, and we try to do that as much as possible.
And where would you source your local currency from, Sameer?
So we then tie up with a lot of these banks, and you have the international banks who are able to offer. So it might not be like a 15-year project finance loan. Then sometimes we then get into rolling hedges. There is a certain risk element involved, but it is still better than pure unhedged position. So we would then tie up with, for example, a Standard Chartered or Credit Suisse or ICBC. These are the kind of banks we work with who are able to offer us hedges in a lot of these local currencies. So we hedge and then do a local currency funding for the C&I play.
Thank you, Steve. Very briefly, I'm also mindful of time. I see we passed the hour.
No, exactly. I echo exactly what Sameer said. So for us, it would be local currency, and obviously same Philippines. We're looking at that market to move into, and it would be local currency in which we deal.
Makes sense. Thank you very much, Manikkan, Sameer, and Steve. I believe Franny wants to present one more slide. Hi, Franny.
Yes, that's right, Robert. Thank you so much for your excellent moderation of this webinar. And thank you, Steve, Sameer, and Manikkan for your insights. Very valuable. And thanks to the audience for listening in and joining us in this webinar. We would like to continue the conversation on C&I on our Future of Energy conference. We have a great session coming up there about C&I, also about Africa and Latin America. So if you are planning to attend our event, Please make use of this discount code. We provide this especially for our webinar audience. Feel free to use it, and we look forward to meeting you in Amsterdam. Thank you so much, and have a great day.
Yes, we look
Thank
forward
you.
to seeing you there. Thanks a lot. Have a good day.
Thank
Bye-bye.
you.
Thank you.
Bye.
Have a good day.